Let's now turn to the private credit outlook, and Chris Andrews is joining us from La Trobe Financial. Chris, welcome back to Ausbiz. Good to
Thanks,
see
Andrew.
you.
Great to be with you.
Of course, really interesting times on markets, which is probably an understatement, isn't it? Really, how are you viewing what you're seeing right now?
Well, it's certainly interesting, Andrew. You've got it right. It's interesting, though, to watch the way markets and the way folks are reacting to this, because in many ways, all that we're seeing in the US is what Donald Trump promised us in his electoral campaign. So, whilst there's a lot of sort of what you might call micro uncertainty, what will the precise level of tariffs end up being at the end of all of this horse trading? We do know what Donald Trump's trying to achieve. He's trying to achieve America that has really reset its engagement, reset, if you like, the post-World War II settlement for the way the US engages with the rest of the world. He wants a US that's more competitive, that has genuine manufacturing capabilities, something that it's really lost over the last 30 years. And I think he's also trying to sort of rebuild that middle American economy and maybe raise some revenue for some tax cuts down the track as well. So we know the direction of travel here, but it is completely unpredictable where the precise policy settings will end up.
And Chris, the question being, at what cost does he want those ends achieved? Some significant damage already done.
It's crash through or crash. I certainly won't deny that. And the jury's out, Andrew, as to how this all plays out in the long run. We know what he's trying to achieve. We know in general the levers he's looking to pull. He's trying to pull the trade lever. He's going to pull the deregulation lever. In due course, he'll be pulling the taxation cut lever as well. But as you say, it's completely unpredictable how it plays out for here. I would just say, though, versus the volatility we're seeing in markets, I think there is some overreaction at times and in parts. You know, specific stocks maybe have particular issues that they need to be thinking about. The news flow around Apple was one example overnight. But certainly if you take a longer view, this will settle down, markets will absorb it, and markets will move on. It's just 5 years ago, Andrew, we were dealing with a global pandemic, and we did manage to absorb that as well. So I would encourage investors to keep their eye on the big picture rather than the minute-to-minute, what will we call it, the tweet flow, perhaps, Andrew.
Indeed. So, Chris, given financial markets have been upended, and bearing in mind, you say that bigger picture and in terms of what Donald Trump is trying to achieve, what does this mean then for private credit, particularly in the States?
Well, it's really moments like this, really, that private credit come into its own, Andrew. And if you've got a really good portfolio of private credit assets to strong non-cyclical names, I'm thinking in the corporate private credit space here in particular, you want to be very careful about this, the sectors you're exposed to. That sort of portfolio will continue to perform over time. In fact, you know, as credit spreads widen a bit, there is the potential to generate more yield in those portfolios. I will say, though, like every investment, though, it's really important for investors that you have a very clear view of who's managing your assets, who's making those investment decisions, how your portfolios are coming together, the real sort of disciplines around their portfolio performance over time. It's important that you have a really clear view of that, because there has been a bit of a focus on private credit over the last 3 to 5 years. And that, of course, means that there are new operators in the space. And, you know, investors have got to be very careful about where they're exposed to at present.
How do you view those credit spreads at the moment, and which direction they're going in?
Well, they've been widening. Look, thematically, they've been widening a little bit, Andrew, which is helpful. And at the moment, funding markets are very sensibly just taking a step back, taking a breath, trying to work out how the dust will settle on all of these policy prescriptions. And of course, what that means is that credit gets rationed, which is why the spreads widened. It's a simple demand-supply dynamic in the end. So that's why credit spreads are widening, which is good for private credit. I will say, though, you know, if you think about all of the policies that Donald Trump's bringing into play, if you think about Joe Biden and the Inflation Reduction Act, it doesn't matter which side of American politics you're talking about, they're both focused on the same big themes: improving America's economic competitiveness, making America a better place to do business, rebuilding that middle American economy. So, you asked Andrew in particular about US private credit. It's a wonderful time to be invested in that space. And we think that dynamic goes for the next generation.
And what of the private credit market here, Chris? How do you view that?
Private credit in Australia, it's a market that's not as deep. It's a market where there are fewer providers of capital and fewer of our corporates seeking capital. So you've got to be particularly selective in the corporate private credit space. Again, though, Andrew, it comes down to knowing and understanding your manager really, really well. The fundamentals of investment are getting the quality of asset right, getting your liquidity structure right, and being really, really transparent about what you're doing at any given point in the cycle. Those are the three simple questions that investors should be asking themselves about any manager that they're engaging in with, whether that's in private credit, whether that's in equities, whether that's any other asset class.